Good morning. I'm Karl Kaufman, and this is the Morning Market Minute for Thursday, May 5th. This is what it sounds like when doves cry. The market staged a massive rally yesterday after the Federal Reserve raised interest rates by 0.5%, its biggest rate increase since 2000. Usually, rising interest rates are bad for stocks. Higher rates mean higher borrowing costs, which especially hurt growth stocks that need capital to expand. Investors also seek safer returns from other assets, leading them to sell the riskier elements of their portfolios. So why did stocks rally yesterday? The market hangs on every word the Fed says. During yesterday's press conference announcing the rate increase, Fed Chairman Jerome Powell was asked if a 75 basis point rate hike was on the table for next month's meeting. A basis point is 1/100%. When Powell answered that there were no plans for a 75 basis point hike, stocks soared. The market has been fighting a hawkish or more aggressive Fed all year. With inflation at 8.5%, the Fed has had to play catch-up to cool off the economy. That left investors trying to price the worst possible scenarios into the market. Dirty words that would make even George Carlin blush, like recession or stagflation. Yesterday was a win for the doves. Powell's comments were less aggressive than expected. The consensus opinion is we've reached peak inflation, so things should get better, or at least not as bad. The Fed still needs to bring inflation down to its target level of around 2%. It's a significant challenge. How can Powell and company lower inflation without slowing economic growth so much that it leads us into a recession? The Fed may be letting some of the air out of the tires of the economy, but you can still drive a while on a flat tire before it starts to damage your vehicle. At least they didn't decide to slash the tires. I'm Karl Kaufman, and I hope you have a profitable day.